Okay? What's your name again? I'm sorry?
My name? Richard.
Richard. Do you mind I stick to Richard? Okay. So I'm going to pick on Richard today. He's like in closest proximity, nothing personal. Let's say at the end of the semester, Richard comes to my office and says, Professor Melnick, you've been talking about all these things, thinking outside the box, businesses, real estate. I want to start my own business. I said, fantastic. Good for you. That's how the most wealth made in this country. Certainly not by working for somebody else. Sorry to say it. So, Richard said, but Professor Melnick, as I'm sure you understand, starting a business requires money as an investment. I said, sure, I understand, Richard. Good point. Well, you know how we students are. We don't have much money. Understand, of course. That's why you're a student, so you could make a lot of money. Well, do you mind lending me $1,000 to start a business? Okay. Well, Richard was in my class, so I cannot possibly say no, right? No, it's hypothetical. I'm joking. Just for the record. So I say, okay, Richard, hypothetically speaking, once again, here's $1,000. Good luck. He goes, Professor Melnick, a year from now, I'm returning this. Okay, sounds good. All right, question number one. You guys ready? When Richard receives $1,000 from me, any income to him? No. Why not? Borrowed money. Remember we said class 1, the funnel of calculating the tax base, which is tax income, starts with income broadly conceived, right? Which is really gross receipts, anything you get except for 2 items, remember? First one was what? Borrowed funds. Why is it not income? Because it's not your money. He's supposed to give it back to me. You guys accountants in the audience. So debit cash, credit liability, no change in stockholders' equity, no increase in wealth, and all that story. Are we good on that? All right. So we're going to practice Socratic method today. A lot of you have been asking me about it more and more. Many of you thinking of wonderful careers that relate to it. So let's talk about it. We're going to develop rules together instead of me teaching you rules. That's in part what Socratic method means. So let's say year passes, right? I get a call. Hello? Oh, hi, Professor Melnick. This is Richard. Remember me? Oh, of course, Richard. How could I possibly forget a student from my class? Professor Melnick, remember I borrowed $1,000? Sure, of course. Well, so I just wired the money into your account. Okay? So he gave me back money. Question, is there any income to me? No, why not? It's return of my own money, return of capital. That's exception number 2, right? To gross receipts that we discussed. Beautiful. Everyone with us so far? We're going to build it little by little. Any questions so far? Everybody's good, comfortable, excited? All right, good. Continuing. Year passes. I don't get a call from Richard. I call Richard. Hi, Richard. Hi. Who is this? This Professor Melnick. Remember me? Oh, yes, of course, Professor Melnick. I remember you. How you done? I'm glad you called. Okay. So I'm just reminding you owe me $1,000. Yes, Professor Melnick, I definitely remember it. The problem is that, as you've discussed in class, if you remember, vast majority of businesses fail. And Professor Melnick, I don't want you to think it's because of your teaching. It wasn't your fault. It's just that that's how it is. So it just didn't work out, and I don't have any money. This is hypothetical. Richard would definitely succeed and make a lot of money. Okay, just hypothetical. Well, you sure, Richard? You don't have any money? You don't have any other? No, nothing. Okay, what are you going to do? All right, question. So now is the moment where he no longer, I'm canceling the debt. He doesn't have anything to pay. There is no prospect of recovery. In fact, maybe he filed for bankruptcy and just ended up with nothing. We could even assume that if they'll make it more exciting. No money. That's it. Done. I lost my $1,000. Question. And again, it's hypothetical. Any consequences to Richard now? Yes. What are the consequences? He's going to be taxed. Everybody understands it? When he got my $1,000 first, we said, okay, we're not going to tax him. It's a liability. Now, there's no longer liability. He just got $1,000 and he never paid taxes on it. So if we don't tax him now, when else are we going to tax him for this money that he made and spent? Everybody understands it. The only reason, once again, we didn't tax him before because he has a liability to pay. Debit, cash, credit, liability. Now, there is no longer liability. No more excuse. That's why he has to get taxed now. It's called cancellation of debt income, and that's the topic for today. Everybody understands, because we're going to be building from here, why Richard has to pay taxes on this $1,000 now. If you don't understand it, I'll put it differently. Anything you get is income. That's it. Unless you could show excuse. Richard had one excuse last time, and that's because he had a liability. That excuse is gone, so there is nothing else to think about. It becomes income. Because why? Because the government says, broadly conceived, whatever you get is income. It's not maybe. It's not let's think about it. It's income, unless you could show us excuse. He has no more excuses. Okay? All right. So, all right, so we're going to build on this. Let's say, oh, and by the way, excuse me, Richard has $1,000 income. What kind of income is this? Meaning, is this ordinary income? Maybe it's capital gain. It's ordinary income, you know. He just got money. There's no capital asset involved in all that other story, right? So it's ordinary income. All right. Change in facts. I call Richard, or Richard calls me a year later, says, Professor Melnick, I owe you money. I don't have $1,000, but I have Facebook stock worth $1,000. Okay? Will you take my stock? And I say what? No. I say no. I don't want your stock. I want your money. $1,000. He goes, oh, okay, no problem. My fair market value of stock is $1,000. Okay? In case you cannot read it, as always, it's $1,000. So I'm going to go out and sell it. My amount realized, which is what I receive on a sale, we call it amount realized, is $1,000. Okay? My cost in this stock, which is what we call adjusted basis, if you recall, it's what I spent on the asset plus any investments minus depreciation. My cost in this stock is, let's say, $600. Okay? So let me go out and sell it. I get $1,000 and I pay you $1,000. Everybody with me? Okay? All right. Question number 1. When Richard gives me back this $1,000, is there any cancellation of debt income to Richard? No. He owed me $1,000. How much did he pay me back? $1,000. There's no cancellation of debt. I got my full money back. Everybody understands it? Any questions on this? But are there any other tax consequences to Richard? Yeah, he just sold the stock at $400 gain. That's gain on sale of an asset. Everybody understands? Everybody sees it? Anybody doesn't see it. He bought the stock for $600. He sells it for $1,000. Should we tax him on the money he made? Anybody has a problem with it? Okay. So in this situation, he has no cancellation of debt income, but he's got gain on sale. Everybody understands it? All right. By the way, what kind of income is this? That's going to be capital gain. And if he held the stock long term, it's going to be long-term capital gain, which will get taxed at what rate? We don't know, whatever his tax bracket is, but lower rate, right? Better rate. Everybody with me? Super. We're going to continue building the rules here. Change in fact. Richard calls me, says, Professor Melnick, I don't have $1,000. I have $1,000 worth of Facebook stock. Will you take it? And I say what? I say no. I say yes, I will take it. He gives me stock worth $1,000, and we're even Steven. Question, any cancellation of debt income to Richard? No, he owed me $1,000. He gave me back $1,000 worth of value. Everybody sees it. Right? But there's something that makes you feel very uncomfortable. Some of you I see starting moving around in your seat. What's the problem? He has to pay some taxes. On what? On the gain, but he never sold anything. His basis was 600. You guys understand that if we don't tax him now, he will never ever get taxed on the money he just made on this $400. Because there is no difference whether he goes out, sells stock, and gives me $1,000, or he just gives me $1,000. This is why this is a little bit more sophisticated conversation for the introductory course. But I'd like you to know that anytime we say sale, it also follows with the word or exchange. Sale or exchange, because it doesn't matter. You sell it or you exchange it in return to something else. Here he exchanged the asset in return for cancellation of debt, payment of the debt. The treatment is as if he sold it first. Same consequences, which means even though he simply gives me stock, we deem that he sold it, and therefore he's going to be taxed with $400 capital gain. Even though he never sold it, but he exchanged it. In a way, actually, he sold it, right? He sold it in exchange for paying off the debt. You could look at it that way if you like. Questions? Yes? You care about me. Hold on. Before we talk about me, let's talk about Richard. Any questions on this? Everybody understands why Richard has to be taxed? So actually, this is a little bit broader of a statement, but I'd like you to know, anytime you're transferring, exchanging, selling property with built-in gain or loss, built-in meaning you bought it for a certain amount, your base is a certain amount, but the value is different, there could be tax consequences. Okay? Divorce is an exception. We said in case of transfer of property pursuant to divorce, there is an exception. No tax consequences. That's not a rule. That's an exception to the rule. Because people are already suffering. And government decided we're not going to cause any more pain and suffering on them. We'll cause it later when they come down and sell the property. Okay? Good? Excellent. Now we're continuing. We talk, new facts, and Richard says, Professor Melnick, I don't have $1,000. I have $800. Forget about $800. $700. Will you take it? Because I don't have anything else and that's it. There's nothing else. That's all I have. So of course I'll take it, right? He's my student, after all. And it's hypothetical. So he gives me $700. Any tax consequences to Richard? Yes. $300 cancellation of debt income. Everybody understands it? Super duper. Any questions? Awesome. Hopefully last, I think, deviation of this example. We talk, and Richard says, Professor Melnick, I don't have $1,000. I have Facebook stock worth, guess how much? $700. Will you take it? I say, okay. Because if I say no, whatever, I say okay, right? So now you have all this exposure at this point. Who could take me through what should be done in this case from tax perspective? Any volunteers? Any brave hearts? Please. Basis is still $600 in the stock. He's going to be taxed on $100 of what? Capital gain. Capital gain, right? Because he sold the stock. It's capital gain income. We've got to be careful here. And anything else? And there is $300 cancellation of debt income. Why? Because the debt was $1,000. He paid me $700 of value, right? So there is $300 of cancellation of debt income, CDI. Everybody understands it? Now, I used to do this for Wall Street Journal many, many years ago. You know, during the tax season, as we're in now, they would get, I don't know if they still do it, they'll get a tax return of an average Joe, and they would have major firm, mid-sized firm, small firm, sole practitioner, and taxpayer himself prepare their own tax return. And guess what? Each time, the results were completely different. Everybody comes up with different tax liability. It just shows you something about the world of taxation, right? So they would ask an expert to review and say who made mistakes, who didn't make mistakes, and all that stuff. So one year, there was a situation that I looked at where a practitioner who did the return said, well, in this situation, there is $400 of income. In other words, the debt was $1,000. He gave up an asset with basis of $600. So in total, there is $400 in income. You got to pay taxes. Is this right? Why is this not right? Why is this a mistake? Well, it is $400 in income. But what's there's income and there is income. Putting $400 as income, paying 39% in taxes, that's 39% in taxes. But splitting it up, which is what should be, because the cancellation of debt here is only $300 or $300,000 if you use real numbers. And the capital gain will get taxed only at half of that, or maybe not get taxed at all, right? If taxpayer is in 15% tax bracket, right? Huge difference in tax consequences. Huge difference. So that's another example of value we as practitioners create for our clients is by making sure that to the extent client is eligible for certain beneficial treatment, whether it's certain tax rates, certain deductions that we provided. Simply saying $400, $400, that's just nonsense. All right? Any questions? Any remaining questions? All right? So that was the topic that I wanted you to know about cancellation of debt income. And, as a matter of fact, there is nothing else that I really care for in this particular chapter. So if there are no other questions, I'd like to move to bigger and better things.